going to talk a little bit about PE ratio. The PE ratio, that is price per earning ratio, which means how much investors are willing to pay per dollar of earnings. It helps investor to determine the market value of a stock as compared to the company's earnings. For an example, if a company was currently trading at PE ratio of 20, which means that an investor is willing to pay $20 to earn $1 of current earnings. If PE ratio is high, then it indicates the stock price is high relative to earnings and it is possibly overvalued. If PE ratio is low, then it indicates the current stock price is low relative to earnings. The current average market of PE ratio is roughly 20 to 25 times of earnings. The companies are losing money do not have a PE ratio. There are two types of PE ratio. Number one, PE ratio TTM, that is trailing 12 months. This indicates the company's performance over the past 12 months. Number two, forward PE ratio. The forward PE ratio calculated is based on future earnings guidance rather than the trading figures. PE ratio can be calculated based on the formula, that is PE ratio equals to market value per share divided by earnings per share. For an example, let's compare PE ratio of two stocks. If stock A is trading at $10 and its EPS for past year was 50 cents, then it has a PE of 20. That is $10 divided by 50 cents equals to 20, and an earnings yield of 5%, that is 50 cents for $10. If stock B is trading at $20 and its EPS was $2, it has a PE of 10, that is $20 divided by $2, and an earnings yield of 10%, that is $2 for $20. In the bottom line, PE ratio indicates how much company is performing when compared to other companies in the same industry. Thank you for watching.